Most people who think they are investing are actually speculating, and you may be one of them. Crypto, lottery tickets, casinos, short-term trading, these are all things people describe as speculating. But what if I told you that good old traditional investment sitting in your portfolio is actually speculating as well? You see, the above activities are pretty obvious. You buy some weird coin with a cat on it, it goes up, it goes down, you make money, you lose money, it's okay, nothing special. You enter the casino, maybe you win big, most likely you lose everything, that's okay too. You knew what you were signing up for. However, in this video I will show you that you are probably also speculating even though you did not realize it at all. And while there is a time and place for that, it is crucial that you know whether you are investing or speculating. Otherwise, you will easily get slaughtered. Hi, my name is Ognan, and on this channel I talk about investing and I help people achieve or at least get close to financial freedom. If you bought Dogecoin in 2021 or a lottery ticket recently, then congratulations, you have been definitely speculating. That's cool. Well, personally I don't think so, but it's okay. You knew what you were doing, you took the risk, you knew the rules of the game, it's fine. This is obvious gambling and everyone knows it. So it's kind of like drinking. We all know it's bad for us, we all know it sucks on the next day, but we do it anyways because we feel that the benefits of the wild party outweigh the damage. We know the rules and we play the game anyway. But there are many other ways that people are speculating. And because they are definitely not outright gambling, these speculations are often called investments, and these people think they are investing, and that's a big mistake. You see, I think that if you buy a house in a city that seems like it is doing well and you keep it empty, you are not an investor, you are actually a speculator. I also think, and I know I will get slaughtered in the comment section for that, but I also think that if you buy a stock like, let's say, Meta, you are also speculating. Let me explain. In the above two examples, unlike with a dog meme coin or a casino chip, you obviously bought a decent asset and you thought you were doing the responsible thing. You purchased a piece of real estate, you know, bricks, stone, cables, land, all that good stuff. It's solid. In the case of Meta, you purchased shares of one of the biggest companies in the world. A company that 2 billion people use and one of the big tech names. Again, solid choice. But you know what people are missing? The reason why I would call these investment choices speculation is very simple, and it's the following. Both of them are not bringing you any dollars. One of them is not bringing any dollars, not only for you, but at all, the empty house. And when they're not bringing you any dollars, the only possible reason why you would buy them is because you hope someone else will pay more for them in the future. And the only reason the person who buys them from you does that is that they also hope someone else will pay more for them in the future. If that sounds like a pyramid scheme, well, it is because it kind of is. It is also called the greater fool theory because everyone buying hopes a greater fool will pay more down the line. And if that sounds too harsh, a bit later I will give you a quote from Warren Buffett, Kevin O'Leary from Shark Tank, and John Bogle, the founder of Vanguard, and you will see they agree with that thesis. Now, in the case of a company like Meta, things are a bit more complex. It is not like a cryptocurrency or an empty house. Meta is a business that makes profit, and if that profit increases, then it is obvious that the business is worth more, and so you can sell it for more. This is sound investing, and I have nothing against that. If that's how you're looking at things, fine, more power to you. The vast majority of people, however, aren't. What most people are actually hoping for is that other people will be willing to pay more for the same profit, which brings up the price of the stock. In the land of investing, this is called multiple. A multiple is the amount of times someone is willing to pay for the profit of a company. So if a business makes 100 million a year and someone is okay to buy it for $1 billion, that's a 10x multiple. If they want to buy it for 2 billion, it's 20x multiple. Hope you got that. Now, with that being said, what most people hope is that other people will be willing to pay more times the amount of money for the same profit that you paid for. In the language of investing, it's called multiple expansion. Why is that speculating, you might ask? Well, let me read you a quote from a recent research I read done by Evergreen Capital. Trying to guess the change in multiple requires one to triangulate and predict interest rates, inflation, fiscal deficit, market sentiment, money supply, oil prices, and foreign wars. Well, sorry, but this requires you to be right about a bunch of things you couldn't possibly know even if your uncle is in the CIA. And this is why if you buy an asset and you are only hoping for its price to go up, 95% of the times you are not an investor, you are a speculator. And that's bad. But how can you remedy this, and what do you do instead? Well, remember our little speculations in Meta and that empty house? Well, what if you put a tenant in the house and they started paying rent? And what if Meta decided to share some of the profits with shareholders by distributing a dividend? The cash flow from rent or the sale of a product is money in the pocket, and the dividend paid from it is money in your pocket. When you rely on cash flow, you don't rely on other people's opinion. You make your own destiny. When you invest for cash flow and as extension dividends, you hold your destiny and your financial future in your own hands. Dividends are what you get from the cash flow. If you want more growth, reinvest them. If you want to pay your bills, pay them. It is your choice, not the choice of the market, and not the choice of other people. This investment thesis is not something I came up with. It is as old as the stock market and investing in general. But a lot of investors simply don't know any better. And it's not their fault. They're bombarded with information that glorifies speculation and even gambling and calls it investing. Here is what 3 legendary investors say on the topic. Talking about cash flow and dividends, just before I share what Buffett, O'Leary, and Bogle say, if you would like to check my top 4 dividend stocks and ETFs for the current economic and geopolitical environment we are in, go to the link in the description of the video and you can get the free report sent directly to your email address. It will be up to date regardless of when you are watching this, because I'm constantly updating it. At one of Warren Buffett's interviews, the legendary investor asked a question that I simply could not get out of my head. If you buy an asset and all trading is banned after you buy it, would you still invest in it? This quote stuck in my head because it emphasizes exactly the point I'm trying to make here. If you purchase a farmland that produces food or a house that people used to live in and pays you rent, you would not be upset at all if tomorrow trading of the asset was banned and you could not sell it, right? But somehow people fail to apply this to the stock market. So this is both my and Warren Buffett's advice. Buy companies as if tomorrow these companies won't be able to be sold anymore, and that's the case for the foreseeable future. Another legendary investor, founder of Vanguard, John Bogle, says investment is about owning businesses, focusing on intrinsic value, long-term growth through earnings, dividends, and reinvestment. Speculation, on the other hand, is betting on stock prices which are short-term in nature. I repeat, speculation is betting on stock prices which are short-term in nature. If you buy a stock with the hope it goes up in a year because other people are willing to pay more for the company than you have, you are speculating, not investing. Kevin O'Leary, a famous businessman, mostly known from the show Shark Tank, famously said that he doesn't understand why people buy companies that don't pay dividends. All of these legends are saying basically the same thing. Buy assets with cash flow, which you can control and evaluate. Don't speculate on prices. Okay, but you might think, I will simply ride the wave of the rising stock price and then sell sometimes in the future. Well, if you are a very disciplined investor with clear rules and big knowledge and experience, and you have said to yourself you will buy Amazon at 100, then based on your calculations, it will go up to 150 and then you will take all the profits. Fine. I'm not a fan of this method, but obviously some people who are successful investors do it. The problem is that for the majority of investors, especially new ones, it doesn't work. This is a poll I did in a local investment group in 2022. The bear market had just started and big technology names had experienced the biggest sell-off in more than a decade. I asked people if they had taken profits at least partially. That was the result. Out of 282 votes, 87% of people had not taken any profit. If they could not sell at least partially their investments in companies that don't pay any dividends after a decade of the biggest bull market in history, what makes you think they ever will make any profits from that investment? The problem is that timing the market is extremely difficult. I don't time the market and I don't advise you to do it either. And now a lot of you might be thinking, but I don't need to sell. I'm investing in these assets for the very long term. Okay, that's a fair argument, at least on the surface. Let's break it down. So basically what you are saying is that you're not planning to sell that investment you just made, but at the same time, you're not receiving any cash flow from it. Let me respectfully remind you what that activity is called. It is called charity. You're basically donating money to Musk, Bezos, Zuckerberg, and company. That's fine if you want to make them even richer and you feel sorry for them, but not if you're an investor. So, what do you do instead? As Buffett, O'Leary, and Bogle said, You need to focus on cash flow, profits, and dividends. This is what you do. You don't speculate on what other people might pay for your investment. You don't hope to sell it for a profit one day. You act as if no more trading is allowed after you buy the asset. If what you heard sounds reasonable to you and you want more help with starting or improving your investing, then I've got a free dividend masterclass I hold live at regular intervals. There, I do a deep dive of exactly what you need to start investing the right way and never speculate with your money again. You can check the link for it in the description of the video. Before you go and after you have opened the link to the free masterclass in another window, make sure to check this video I did that goes deep into exactly the topic I briefly covered today. It is a long 48-minute video where I do a deep dive on all the topics explored today with examples and real life stories. Thank you for watching, and I'll see you there.